Hey everyone, welcome back to Corporate Decoder, the place where we break down the big business world so you don't have to. And let's just say Vivakor Incorporated is serving up some interesting adjustments in their latest report, perhaps a little too interesting. So today we are diving into a Form 8K filing from Vivakor Incorporated. These reports are basically like a company's diary for major events that happen between their bigger quarterly or annual reports. Think of it as a special bulletin for shareholders and the public. If you like getting these insider looks at corporate moves, make sure you are subscribed. And hey, we have a fantastic Discord community linked down in the description where we chat about these filings and more. So join us there. Alright, so Vivakor Incorporated, or the company as they call themselves here, had a bit of a financial dance. Back in July of 2025, they issued a note, a kind of loan, to a company called JJ Astor and Company for a whopping $5.9 million. Now, they only actually received $4.4 million of that, after some fees, which is important to note right away. Fast forward to the 12th of January 2026, and the lender, JJ Astor and Company, decided to convert a portion of that debt into stock. Specifically, they converted $50,000 of the loan amount into over 11 million shares of Vivakor Incorporated's common stock. Now, this is interesting because it means that instead of paying back the money, the company is giving away ownership in the form of these shares. The key takeaway here is that this conversion wasn't something Vivakor Incorporated chose to do out of the blue. It was part of the original agreement with the lender when they took out that initial loan. When a company issues debt, there is often a clause that allows the lender to convert that debt into shares under certain conditions. This is often done when the company's stock price is doing well, making the conversion more attractive for the lender, but it also dilutes the ownership for existing shareholders because more shares are now out in the market. Now, a detail that might fly over some heads but is actually pretty significant is with these shares. They were issued without what is called a Rule 144 restrictive legend. In simpler terms, this means these shares aren't immediately restricted from being sold by the new shareholders. Usually, when private companies issue stock, especially in private transactions like this, there are rules about how and when those shares can be sold publicly. The fact that these are free of that restriction suggests the company believes they've met certain legal requirements, probably related to the lender being an accredited investor, which is someone with enough financial knowledge and net worth to understand the risks of investing. This makes it easier for JJ Astor and Company to potentially sell these shares on the open market sooner, rather than later. And they specifically mention that this whole issuance is exempt from the usual SEC registration process because the lender, JJ Astor and Company, is considered an accredited investor. This is a common exemption for private placements, meaning they are selling securities directly to a select group of sophisticated investors rather than to the general public. They are essentially saying this deal was with a knowledgeable investor who understands the risks involved, and that is why they did not need to go through the full complicated registration process. Okay, so let's step back and look at the bigger picture here. Vivakor Incorporated took on debt, and a portion of that debt is now being converted into stock. On one hand, this helps the company reduce its debt burden without necessarily coming up with cash right now. On the other hand, it increases the total number of shares outstanding, which can lower the earnings per share for existing shareholders and potentially depress the stock price if those new shares are sold aggressively. The fact that they issued these shares freely transferable suggests they are confident in their legal standing, but it also could signal an upcoming influx of shares available for trading. Looking at the company itself, Vivakor Incorporated, it is listed on the Nasdaq Capital Market under the ticker symbol VIF they identify as an emerging growth company, which basically means they are a younger company that gets to follow some less strict regulatory rules, including opting out of extended transition periods for new accounting standards. This is a common status for smaller or growing companies. Now, I don't have their full financial statements here, but this 8K filing focuses on a specific event, the conversion of debt into equity. This type of event is often a sign of a company that might be facing financial challenges or is choosing to manage its capital structure in a particular way. Sometimes, companies that struggle to raise cash through traditional means might rely on convertible debt, which can then convert into stock when things are looking up or when the company needs to meet certain obligations without using cash. What is missing here are the actual revenue numbers, profit margins, or cash flow statements that would give us a clearer picture of the company's operational health. This filing is more about a transactional event. So the big question is, why did the lender decide to convert now? Was it a strategic move because they see a brighter future for Vivakor Incorporated, or was it simply the terms of the debt agreement kicking in? Perhaps as a way to get some liquidity back without the broader financial context, it is hard to say definitively. Investors should always look beyond just these specific events and examine the company's overall financial health, its management strategy, and its competitive landscape. So here is my take. This debt to equity conversion signals a shift in Vivakor Incorporated's capital structure. While it might alleviate immediate cash pressures, it dilutes existing shareholders. The fact that the shares are freely transferable is a notable point to watch. It could mean more selling pressure on the stock if the current holders decide to liquidate. The company's status as an emerging growth company offers some regulatory flexibility, but it also means that investors need to be more diligent in understanding their financial position and future prospects, as they might not have the same level of detailed disclosures as larger, more established corporations. The key risk here is increased share count leading to lower per share value and potential downward pressure on the stock price from the newly issued shares. An opportunity could be if this conversion is a sign of underlying confidence in the company's future growth, allowing it to manage its debt more efficiently. Alright, that is our breakdown of this Vivakor Incorporated filing. What is your take on these numbers and what they signal for the company's future? Do you think this debt conversion is a positive or negative sign? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching. See you next time.